I'm here with Atlanta Fed President Raphael Bostic, our host for today and for the conference here. Raphael, let me just start off with, I think we know where you are on rates. What do you think about where the market is? When you look at where the market is priced for the year end, it's a 440, 439, what you call it, January Fed funds contract, which tells you what they think for the full year. That's 75 basis point difference. Is that worrisome now? What explains it? Does something need to be done about it?
Well, first of all, good morning. It's good to have you here, Steve. Always good to have you at our conference. You know, I've been really wondering about this for a long time because, you know, in my world, inflation is not going to come down very quickly. And in that regard, then cutting rates doesn't really fit into that scenario. So, you know, the markets, I think, have been pretty optimistic about how easily inflation will respond to our policy. Honestly, I hope I'm wrong and they're right, because that'll mean that the economy is in balance sooner than later. But it's not my baseline case at all.
What accounts for the disconnect, do you think?
You know, that's a good question. I try not to speak for the markets. What I would say is, even in my building, there is a lot of debate about how strongly our policy is going to bite on the economy. Some think it's actually going to bite really, really strong and come down fairly rapidly. But our fairly rapidly is not even as rapid as the markets are. So my baseline case is we won't really be thinking about cutting till well into 2024. I think what we're going to see is just an orderly decline. I'm hoping that we see what we've seen over the last several months, where inflation has come from a very high level to now it's just a high level. But even if you look at most measures of inflation, they're still 2 times where our target is. And so there's a long distance still to go. Okay,
so that's the kind of downside debate on rates. 5 1/8, is that it, do you think? Or might you have to go higher?
Well, if you had to ask me, I guess you did just ask me, if I had a bias between going up and going down as our next action, I would say we might have to go up. All right, what we've seen is that inflation has been persistently high. Consumers have been really resilient in terms of their spending, and labor markets remain extremely tight. All of those suggest that there's still going to be upward pressure on prices. Now, that's not my base case either. For about 6 months now in the dot plot, this is at the level I want us to get to, and now we can wait and see. But if there's going to be a bias to action, for me it would be a bias to increase a little further as opposed to cut.
Mr. President, you have not had zero response from unemployment from your rates. You've had negative response. You're down now on the unemployment rate. Does that tell you have to lean harder on this economy to get a better response in the job market, to have looser employment conditions and reduce the pressure from wages on inflation?
Well, I wouldn't say we're negative on employment. When I talk to business leaders, and I go around and talk to lots of folks, they all tell me the labor market is easier for them today than it was 12 months ago, which suggests that there is some easing that's happening in the labor market. Now, it's not happening super fast, and we still have a lot of dynamics in the pandemic that are affecting labor force participation in segments of the economy. But I do think there's been progress.
What about on inflation? Has there been progress?
There's definitely been progress on inflation. And, you know, for me, I think we've done, if you think about this, the easiest part of inflation reduction.
Right.
Now it's going to take some time to work through the services. Goods are going to still stay somewhat volatile. You know, one thing I would say that's very encouraging to me, when you look at the CPI report that came out last week, less than 50% of the items in the basket now are showing 5% increase or less.
But you're only down a tick. I mean, there was only a tenth. There wasn't much progress at all.
But as you know, there's a lot of math that goes into the calculation of these things. I think in the next several months, the math is going to work in our favor, and the economy is going to work in our favor, and that's what's really important.
Becky?
Thanks very much. Raphael, there was a really interesting piece by Greg Ip in the Wall Street Journal last week. I'm sure you saw it, but he suggested that these levels of inflation, while they're down, they're still pretty elevated, and his concern is that as consumers and businesses get used to that higher inflation, 4.5%, 5%, that's where you get into a problem, because businesses can then continue to raise prices. Consumers are kind of used to that. They're used to then going into their bosses and asking for more money. And that's when things get a little more concerning. Do you share that concern?
Of course. I mean, if inflation expectations really become unanchored from the levels that we want it to be, then everyone's behavior changes, and it can almost be a self-fulfilling prophecy. Now, fortunately, as we do our surveying of businesses and my conversations with bankers and just regular families, they all tell me that they understand that this is still a very short-run episode. and that they're not expecting the long-term reality to be at this level. There's still a lot of confidence that our policies are going to be able to get inflation back down to our 2% target. And to be fully clear, we're going to do all that we need to make sure that that happens.
So, President Bostic, if this is your long, if you thought we were going to be here and this was a good target for a while, and now we got here and you still think we might need to go a little bit more, if you got that, what happened in the financial sector, which everyone says added 50 or 100 basis points worth of tightening, why aren't you taking that in? Why didn't that make you think, all right, we're there already, we don't need to go any higher? If you're already at 5.25, and we get another 50 or 75 or even 100 from that, why don't you say, wait, I didn't know but that was happening, so this makes me change that maybe we don't need to go as far?
I'll say two things on this. So first, I don't really do that calculating like how much bank action translates into Fed funds rates. I think there are a lot of implicit assumptions there that makes that a really difficult exercise. But the second thing I would say is when we raised rates, my expectation was that financial conditions were going to tighten. The crisis did that on some level. Now, I would have hoped that the financial conditions tightened in a somewhat more orderly fashion. But we're seeing the tightening that needed to happen, and now the question is, how much is that really going to bind on activity? In my baseline case, I think it will continue to slow down the economy, but it's not going to be in big chunks. I think this is going to be a gradual thing over an extended period of time, and that's why I think the appropriate policy is really just to wait and see how much the economy slows from the policy actions that we've done.